why experienced traders lower their leverage. So I've already done a Bybit tutorial on the mechanics of placing a leverage trade. And in fact, from doing that tutorial, this is where some of these questions started coming up. People were saying, but how do I know how much leverage to use? What's a good and appropriate way to use risk management? So I'm not going to deal with the mechanics of how to place a leverage trade right now. We'll include the link to the Bybit tutorial down below so that if you need to understand how to place a trade, that's kind of the place to start. This is more about how to choose where you put your, or choose what amount of leverage you do, right? So let's talk about the mindset of this first, right? Because there are some false assumptions that if you've got them, you're probably losing money. The first would be higher leverage makes you more money, right? And I know you're going to say, Teresa, what? What are you talking about? Of course, higher leverage makes you more money. Well, by the end of me going through this slide deck, I hope that you understand, using this comparison, that higher leverage can make you more money in very specific scenarios. In many scenarios, it actually has you making less money, and I want you to understand why that is. The other thing is the exchange reports higher profit when I increase the leverage, therefore I must be making more money. If this is your assumption, that's a false assumption, and I'm going to explain that right now so that you understand why. Okay, I'm calling this one a tale of two trades, right? I'm going to show you two comparable trades so you understand this principle. Here's the assumptions of this trade just to make it easy for you to go along and do the math in your header. If you want to check my math, feel free to tell me if I've made any errors. I am dyslexic. So if I've made any errors, I'll come back and correct the slides. And that's one of the reasons I created a little cheat sheet spreadsheet for you guys that I'm going to put out in a future video, but I want to use it and test it for a while just to make sure there's no mistakes, because I realize when you make a mistake in a tool you put out to the public, that can have significant consequences for people in the trading world. So I never like to put anything out until I've been using it for a little while to make sure there's no mistakes. And I actually request of you guys, if you ever find mistakes in my work, please put it in the comment field or reach out to us and let us know, because people might be losing money because of that. Okay, so we're going to assume the price of Bitcoin is $50,000. I chose 50,000 even though at the time of doing this video, we're in a bit of a slump and we've come down from that level. But 50,000 is an easy number to do the math from. And I'm going to use two equal trades, both $10,000. Again, using a $10,000 trade, really easy to do the math from. Okay, we're going to assume an average funding fee rate of 0.05% every 8 hours. Okay, that's generally an industry average if you go across different exchanges and at different time periods. That's a reasonable assumption to make, but funding fees do change, and it does depend on what exchange you're operating on. And we're also going to use the assumption that you leave the trade open for 24 hours. Now you can change these numbers to anything you want and do this example, but this is basically to just show you the difference between a high leverage trade and a low leverage trade. Okay, so we've got two trades. One trade is a 40x leverage trade. The other's a 2x leverage trade. So I took these extreme examples just because they're easy to do the math on. You have $10,000 in your account. So let's say you're trading on Bybit. The total amount of Bitcoin in your account equals $10,000 US, okay? Most traders always risk a consistent amount of their portfolio on every single trade. Okay. In fact, most seasoned traders recommend you risk 2.5% of your account every trade. Some go as high as 5%. But normally you would either do the same thing all the time or only go up to 5% or higher if it was a trade you were super confident on. For example, if you're breaking out of a multi-week pattern and every single indicator is bullish right now, then you might risk more. But in general, the way you do good risk management is you never change the amount you risk on every trade. That doesn't mean your trade size is the same every time, because you need to determine good risk management where your stop loss goes and how much leverage you're using. So let's talk about what that means. So let's say in this case, you were using a trade size of $10,000. Well, what do I mean by that? Well, you're going to have margin in each case, right? So in the case of the 40x leverage trade, your margin is only $250. So that means you're borrowing from the exchange $9,750. Sorry, I'm trying to do that math in my head because I didn't put a row for that. In this case, on a 2x leverage trade, your margin is $5,000, so significantly more margin. You're borrowing a lot less from the exchange. You're only borrowing $5,000 from the exchange, okay?
Teresa, can I stop you there just for the new guys?
Yeah.
When we say margin, we're meaning this is your money from your portfolio that you have invested in this, and the rest of that 10,000 is coming from borrowing it from the exchange.
Yeah, thank you. I appreciate that clarification. Okay, so in this case, and I don't recommend using the liquidation price as a stop loss, but there are traders who do this. They just say, well, it's easy to do the math, so I'm just going to let the trade liquidate instead of putting a stop loss in. Or they might put the stop loss 2 or 3 pips above the liquidation price, but this makes it really easy to do the math, right? So in other words, if the price in this case moves $5,000 up, in this case, if you did the math, you would make $1,000 on this trade, right? Now, interestingly, on this same trade, because it's a $10,000 trade, if the price moves $5,000, you're going to make the same $1,000. So the amount of leverage you used didn't affect the amount of money that you made on the trade, right? What's different about these two trades is the exchange is going to tell you in this case, you made 400% profit. And in this case, they'll tell you you made 50% profit. Well, why is that? Because the exchange is reporting the profit on what your margin was. So if you made $1,000 in this case, that was 4 times the amount of your margin. And so the exchange is going to report it as 400% profit. Is that clear, Nicola? Is that?
Yeah, I think, yeah. Yeah.
In this case, the exchange is saying, well, actually, it's relative to this. Actually, my math might be wrong here. It actually should be 20% profit. Sorry, I think I've got an error on the slide because it's reporting it relative to the $5,000 that was your margin, right? So actually the profit here should be 20%. And I'll fix that on this slide later. And that's because they're reporting it relative to this number, right? But the amount of risk you took in both cases was still $250. So they're not reporting it relative to the risk you took. They're reporting it relative to your margin. So this is the way.
Can I just go over that again?
Yeah.
So where you've got the 400% profit versus that's supposed to be 20% profit.
Yeah.
That's relative to your margin, like your money, your hard-earned cash that you've got in there, right?
Correct.
So
I'm just going to fix that right now.
When you're leveraged higher, you've got higher leverage. That means you're borrowing more of the amount in the trade from the platform. You're not putting your own money in. Whereas the lower leverage, you're borrowing less and you're putting your own money in.
Correct.
Right?
So in this case, because more of your money was in the trade, you borrowed less, but they're reporting your profit relative to this margin amount.
Right.
Okay. And so, of course, this seems a lot sexier than this, but at the end of the day, you've actually made the same amount of money on both these trades.
Yeah.
Okay. Here's where the difference is. In this trade, you paid $14.64 in funding fees using, just doing the math, the 0.05%. And in this case, you paid half the funding fees. Now, in the case that you're keeping a trade open for multiple days, that really starts to add up, especially if you're doing pattern trading or positional trading and you're keeping leverage trades open for a long period of time, right? So in this case, the actual profit you made relative to the $250 that you risked was 294%. So if you just take away the funding fees, like this is literally the amount of money you made on the $250, still a nice profit, right? You've made 294%. In this case, you actually made 297% on the money you actually risked, right? Because you weren't risking $5,000, you were risking 250 because you used a stop loss that was at 5%. So the majority of the money you put into this trade was not at risk because your stop loss protected it.
So I think that deserves a like, at least, guys.
Yes. Okay.
That is incredible. And you know what, Teresa? I actually noticed this because when I started trading leverage at 3x, I noticed, wow, my portfolio was going up and up and up and up. And when I switched it up to 5x and 10x, I'm going, hey, I don't seem to be making as much money. In fact, it looks like I'm making less. How can this be? Because the percentages, as you said, they look very sexy, but the actual amount of coin that you're getting was less than what I was getting when I was trading 3x. And that's when, you know, like I had trebled my portfolio in a really short space of time on a 3x leverage.
Yeah. So really the only time you want to go into high leverage trades is when you've already got a trade open and you want to add more money to it because it's significantly in profit and there's a new pattern that's breaking out in addition to the one you've already traded, right? So you do see a lot of traders in the industry that scale up their trades, right? But you don't start out at the high leverage trade because the risk in getting into those trades is way too great. Then you're risking a lot more than 2.5% of your portfolio. If you've enjoyed this video, don't forget to give us a blue thumbs up, hit the subscribe button, click the notification bell, and select all so you'll receive notifications when we upload new videos. Thank you to those of you who've made donations to our channel. All donations received go to support infrastructure projects we do here in our conscious community in Costa Rica. They help provide additional jobs and wonderful infrastructure that helps bring in more tourists to this region. So your contributions do make a really big difference to the people in this area. We also run an advanced mastermind group of volunteers who help us research different scenarios for the price action of Bitcoin. We meet weekly. We discuss things that we might want to dive back into the charts and research, and we help each other and discuss those scenarios. In future, we will be playing additional videos on scenarios that can affect the price of Bitcoin, and many of the things that that mastermind comes up with will become videos on this channel. So if you would like to join that mastermind, please feel free to reach out. We'd love to have more people involved. The more people there are, the less work it is for any one of us, and the more solid all of our trading becomes. Thanks for watching Conscious Crypto, and until next time, trade consciously.